Hello and welcome to Investing Confidential. Big CPI number came out. As you can see here, there's all the headlines, inflation cooling, likely end to Fed rate hikes. That's the only part of the headline that I agree with. I think the Fed basically is done, finally. And but, as I will go into later, there's going to be no rate cuts. And there is something that you should be legging into for sure. I mentioned it a couple of times. I'm going to go into what you should be buying, what's going to be outperforming going forward. But let's jump into this. As always, let's look at the data. Okay, so here is the CPI table. And look, it's very easy to figure out why the CPI, which, as I told you before, it's completely an unreliable source. But since everyone looks at it, technically you have to pay attention to it. See? So it's really just two things: energy and used cars. That's it. Food was up. A lot of other things were up, but essentially energy, which, I mean, you could have anticipated this. If you drive around, obviously gasoline has been coming off. You look at crude oil coming down. It hasn't broken down. It's just come off from the highs. And it was obvious that this was going to affect the CPI in October. And then you have used cars. Now, used cars is just very volatile. First of all, I don't even know why used cars prices were even up, because to me, that's fake news. Because if you watch TV or anything, you know that these car companies, they can't sell cars right now. There's incentives, 10%, 15%. They're cutting prices left and right off MS, when a year and a half ago, they're telling you that you don't have to pay over MSRP. And I told you that. Do not overpay for a car. Just like today, if you don't have to, don't buy a house. You're going to be overpaying dramatically. And housing is still a problem. Okay, it's still a problem. Rents are coming down hard, but prices of houses are still very high. Okay, this is all going to factor into the CPI in the future. And it's, as I said, it's not going to be positive, because when you start experiencing deflation, which is what we're going to be seeing, you're going to wish there was inflation. You're going to wish there was inflation, because deflation is much worse. So again, it's understandable what happened here, but at the end of the day, food is still expensive. Okay, relatively speaking, energy is still expensive, but obviously it's come off from the highs. And used cars, thank God used cars have come. They were artificially up. Okay, and so look at it in perspective here. So here's a chart. Okay, so here's a chart where you can look at graphically what's really affected this number. Okay, and you see drastic. It's energy. It's all energy. Okay, food is still going up. Food is still high. All of the items high. But look at energy, massive. So when you see that, it's understandable why the headline number was up there. And then you look at the actual release itself. Again, this tells you everything. Shelter continues to rise. Okay, that's the cost of housing. Okay, that's going to come off eventually, but right now still continue to rise. And then we got food index still increasing. Okay, it rose 0.2% September, even higher in October. And energy coming off. So, things we do every day, sure, the gas at the pump is cheaper, but food is going up. And previously, a few months ago, the food was going down, energy went up. This is what you call sticky inflation. Okay, not transitory with the Fed, sticky. So you can't rely on the Fed. Okay, right when it comes right down to it, they're just not reliable. And by the way, these CPI numbers are not reliable. People are trading on them, go right ahead. They're not reliable. And finally, we have the receipts. Finally, we have the receipts to show. And it comes from the same media, the same mainstream media that shows that champions all this crappy fake news. Okay, so here we have CNBC got together with the NRF, national this national organization that actually sells data to hedge funds, okay, on consumers. So this is really, really good data. What they do is they get credit card data from, I think, 9 million credit cards, okay, and from all the credit card companies, and they compile this data. And as you can see here, this is actually very reliable data. As you can see here, okay, again, seasonally adjusted, month on month, retail sales coming down hard since the summer, hard. And what did we see previously on retail sales? The retail sales, the market went up, oh, bullish, false, completely false. That was a month ago, completely false. Because the data from the government, from the Census Bureau, and from the Bureau of Labor Statistics, which is the ones that compile the CPI, this data is flawed. Absolutely flawed. They're getting this data through mail, through fax, and through phone calls, your home numbers. Who on earth answers their phone at home? Nobody. Who gets faxes? Nobody. And have you ever tried how slow the U.S. mail is? Come on. This is absolutely a joke. And today, massive move in the market makes no sense. It makes sense because of the number, but again, you're trading on bad information. Okay. And so here, this is the Census Bureau, which comes out with all this consumer data versus what the real number is. And the real number, it comes from credit card spending. This is what this new index is going to be showing. Ex auto and gas. Look at this number. Folks, this is dramatic. Absolutely dramatic. You got retail sales numbers that the last retail sales number ticked up very strong. The S&P went up, NASDAQ, everyone's going crazy. Oh, the positive. The consumer's strong. The consumer's not strong, folks. Look at the consumer sinking. If we had this information going back, we don't. It's going back. It only goes back to October. We had to go 1 year, but if we go back, we'll show even more dramatic moves. But again, you're buying the market based on consumer and retail information that is false, that keeps getting revised lower. And so today, we're buying the market because the CPI says that inflation is going down, according to them. Sure, if you're a trader, take advantage. Okay. And the other thing is, what people aren't saying, is there were massive shorts in the market. Okay, they were getting squeezed already. And this is the capitulation. So today, by 4 o'clock today, everyone who's bullish is in the market. Bullish, bullish, bullish. What does that tell you? Where the market's going in the short term? Down. Again, these are bear market rallies. Okay, and then the other thing is, you can see here, this is what also is driving people to buy, rate cut probabilities. You know, here, a little headline here, Goolsbee says the progress on inflation. He's right. Housing is still too expensive. Very, very expensive. But if you crumble housing, which they have to bang housing down, this is going to hurt consumer spending, consumer confidence massively. It's also going to hurt people who are using their houses as a piggy bank to borrow money against. And so this rate cut probability, going back to this 87% in June, that's insane. There's no way you could make that probability. That's just ridiculous. I don't know who these people are, but it's ridiculous. Absolutely ridiculous. Nobody knows. Nobody knows. But in the short term, the Fed is telling you there's no way there's going to be any cuts. So to buy this market based on, 7 or 8 months down the road, you think the Fed's going to cut. By the way, if the Fed does cut 100 basis points, like some of these idiots are saying, you better hope they don't, because what that's going to tell you is that the economy has collapsed. If the Fed has to cut, that means our economy has collapsed. That's what it really means. Okay, so what should you be buying? Okay, it's obvious today, as I think I mentioned it. Okay, I'm going to show this chart again. The small caps have been incredibly destroyed in terms of performance by the large caps, massive underperformance by small caps. So guess what? When you have a market like today, and whether it's short buying, professional, whatever the case may be, as you can see here, this is what you want to see in the future, right? So this is where you want to position yourself, because today, the IWM, which is the small cap Russell 2000, is up 5%. The S&P up 2%. Okay, here's the outperformance of the S&P on top here versus the Russell over 1 year. S&P up almost 12%, Russell down almost 9%. So there's going to be catch up going on, and it's going to be, so if you need to buy something, you're much better off with IWM. You're going to get much more bang for your buck than you will the S&P. And so long IWM, short S&P is probably a decent trade, a hedge trade, because it's showing you today when money piles into the market, they're going to pile into small cap names, stock picking names. And we've always talked about being stock picking. So market's up today, very strong, no rate cuts coming. That'll be factored in eventually. But again, the data, look, I'm not going to dispute the market is up. The market's up strong. And it is what it is. But this data is flawed. And I just showed you why you cannot rely on this data. It's obvious. Completely flawed data. So enjoy the rally while it lasts, because it won't last much longer. Everyone's bullish now. So think about what that means. So if you're an investor, be careful out there.